Good morning, everybody, and welcome to the first post-summer LaingBuisson webinar. We'll just let everyone join. We've got about 70 people, and it's clicking up. Very good. I think people will continue to join. We're just about to pass through 100. But it gives me enormous pleasure to welcome a fantastic lineup of panelists this morning. The topic is growing with children's services, and children's services have always been a niche market, which has in some ways been seen as the sort of the Cinderella of care. But equally, I think it's absolutely a fascinating market because it's one where private equity has been very, very involved and has actually been instrumental in building some of the larger providers in the market. And if I look to people like Priory, for example, or Outcomes First Group, or indeed Cambion, which was acquired by CareTech, all have had a significant amount of private equity involvement over the years as they built businesses of scale. Today, we're really focusing on special needs schools, fostering and residential care. And I think the questions we've asked the panelists to address are very much around how their business has coped with COVID and really the outlook for the sector. How do you maintain high quality in a challenging funding situation where you have to manage potentially significant reputation risk? So to kick us off, just encourage all the attendees to log into Slido. Slido is the tool that we use to manage the live polling and also the Q&A. So if you have a laptop, a tablet, a smartphone, if you've got a browser, if you just open it up and go to slido.com or sli.do, either of them work, that will bring up a page in your browser where you can see essentially this graphic at the bottom, joining as a participant, and then a hash code and enter event code. And all you need to do is put in the word children and click join an existing event. And that will take you through to this screen here, where it should say growing with children's services at the top. And the elegance of this is that we have both Q&A and polls on one device. If you click on the polls, then you can access the poll, and I will run a poll in a moment. And get the feedback from the attendees on one of the questions that we've asked. On the Q&A, you can type in your question here and submit it. But most importantly, you can then upvote the questions. So as we get into the Q&A, which is actually often the most engaging part, it allows you to upvote the questions for the panelists that you particularly want to have answered. So on that, I'm going to switch to the poll to see how we've been doing. And I can see 10 people have managed to vote already, which is great. What is the greatest challenge for children's services to grow? Is it funding competition? And by that, I mean competition against other social care services, as well as protecting the economy, the NHS. There are a lot of very worthy causes out there. There's clearly a finite amount of money and a lot of very good claims on that money. Is it staff fatigue, which has been a theme that's come up recently, that we've spent 6 months in lockdown and it's taking its toll, both in terms of mental health, but just generally in terms of exhaustion among staff. Is it new admissions? We're in a new academic year. How have local authorities coped with running their panels during lockdown and actually ensuring new admissions? Or is it COVID more generally? So we'll let that continue to run in the background, and we'll come back to it at the end and see where we are. But if we just return to the slides, what I thought I'd do is just set the scene very briefly in terms of the market that we're looking at. So the three market sectors, special education, foster care, and residential care. I think the first thing is actually a very significant market. So SEN schools is a £4 billion market, and the independent sector is only £1 billion of that. So this is actually a very significant market where independent providers only have 25% market share. In foster care, it's a £1.7 billion market, and the independent sector has coming up to 50% market share. So the outsourcing has been greater to independent providers in foster care. And finally, in residential care, it's a £1.5 billion market, and the independent sector has about 2/3 of that market. So in fact, those three markets are effectively declining size from top to bottom. So 4 billion, 1.7, 1.5. But actually the independent sector's penetration of those markets is least in the largest markets and greatest in the smaller markets. If we just look at the providers, we use this formula which essentially looks at the market concentration of the top 4 providers in each market. And you can see here that in special education, the top 4 providers only have 18% market share, whereas in fostering, they have 42% market share. And in residential care, again, it's only 23%. So the fostering market is much more concentrated from a competition perspective, even though it's the least outsourced of the markets, or rather it's less outsourced of the markets, whereas both special needs education and residential care is much more fragmented. And if you look on this page, I mean, you can see that actually a number of these players are rumored to be for sale. So Priory is for sale. Arcadia are very public about that, and they've mandated Rothschilds. NFA, which has now been renamed Outcomes First Group, is likely to come up for sale just because Sterling Square have owned that asset for so long. Witherslack equally is likely to come up for sale. Keys, which is owned by G Squared, is for sale again through Rothschilds. And just more generally, there's a lot of activity in this sector. And therefore, I think that's particularly interesting for us to explore today. Just a quick plug for the market reports. The new LaingBuisson market report on children's services will be out in the next 2 or 3 weeks, and also will reflect COVID, which is important. Although I have to say, I think this has been one of the sectors that have been COVID winners relative to a lot of other parts of the economy. So on that, I would just like to introduce the panelists. We've got a really interesting mixture. We've got 2 operators in the form of Paul Callander, the CEO of Horizon Care and Education, which is relatively overweight or relatively more focused on special needs schools. So as a sort of representative of that schools market. We've got Sandy Foxall-Smith, who's the chair of Compass Community, which is a large fostering business, so representing that fostering market. And Ian Marlowe, who's director of Ardenton Capital, who purchased Pebbles Care recently, which is a children's residential services business. So 2 operators and 1 investor owning a portfolio company. And we've got effectively operators active in all 3 of the markets that we talked about earlier. And then Jamie Stuart, who's a senior director at Clydesdale and Yorkshire Bank in the healthcare team, who are a very active lender into this sector, and who we're delighted to be partnering with today and supporting us as we explore some of the key themes. So just to remind you, if you want to submit a question, just go onto Slido, register for the children as the event, and put the questions in there, and we'll come back to them at the end. But what I'd like to do is to start by welcoming Paul Callander, who is going to tell us a little bit about Horizon and himself and his views on the sector and the outlook to start us off. So Paul, over to you.
Okay, thank you, Henry. And good morning to everybody. And thank you for joining this webinar. Please be gentle, this is my first ever one. So I'm just sort of, hopefully the technology will work for me. I'm sure it will. I've been guided by Henry. Yeah, I think it's a great privilege to be able to talk about this amazing sector. And I just want to give a little bit of an insight about, obviously, Horizon, but also I thought it might be quite useful to talk a little bit about my own involvement in social care. Most of that has been in adult services, but latterly I joined Horizon in the middle of 2014. at a time of huge growth and huge opportunity, but also some significant challenges as well. And over that tenure, we've had multiple opportunities and a focus on what we consider to be the key issues in and around children and young people. And that is very much the focus, and putting the focus on the child and the young person. What we need to bear in mind here is that the children and young people we're talking about are and have been taken into care, and through no fault of their own. And I think that's really important that we understand that. So imagine a child of 8 or 9 being taken away from their family environment and placed into care under the stewardship of the local authority. That is a traumatic experience for any child, you can imagine, even if that environment is an abusive environment. So what we have to do is to recognise that, and to make sure that we get around that child. We provide a stable environment. We provide great mentoring to show that child is a different way of living, because quite often the behaviours are displayed in terms of aggression or inappropriate behaviour or over-sexualisation. So it's making sure that we provide a stable and safe place for that child to be. At the same time, educate that child, and at the same time then obviously hopefully pass them through the system into either more appropriate types of care, which in my view is things like foster care, which Sandy will be talking about. But ultimately, if a child is to stay with us over their period of time through their age, is to get them into adulthood. So you deferred this time and time again about care pathways, and I've been part of organisations that bang on about pathways, but genuinely we at Horizon and in this space and our partners, we have a proper pathway that actually can take a child at 8 and get them through to a sustainable, independent living as an adult post-18. And the way we do that is very much focused on how we're structured. And I, coming into the organisation, I set very high standards in terms of, and a benchmark in terms of the way that we operate and the values that underpin everything we do. Now, this slide here shows you some words that probably most of you have got some of them, if not all of them, in your own values. But for us at Horizon, they're very much, if you cut us in half, these are the words that really are there. And we recruit our employees based on these values. So we have an assessment-centred type approach. It's not just an application. It's not just the fact that you come along for an interview, you have a pulse, you've got a clear DBS and you're in. We actually make sure that our employees exhibit these core values. So for instance, compassion is one of the key things. You've got to have an empathy to work in this space. You really generally do. And that in itself is something that needs to be coming out through their behaviours. So for instance, I have a no swear culture in the organisation at all. These children swear a lot to express themselves, but if our adults are also swearing in services, all the support services, then that can also lead to, it underlines that behaviour. So it's little bits like that that make all the difference, and that holistic kind of view in terms of how we approach the children across our 3 services. So since in my tenure through, we've moved through quite a lot of M&A. We've extended our bandwidth. So we're obviously core was our Horizon education, residential services. We had a small amount of education, and that was that. But we've grown our 3 operating divisions now to have a strong residential set of services, strong education, and also moved into transitional services, leaving care. All of our employees across these 3 different types of services, and they are different because you've got education, educationalists, you've got full-blown 24/7 residential care, then you have floating support in transitional services. They're 3 discrete types of services. Example, all our employees, these core Horizon values. Henry, do you want to go to the next slide, please? Thank you. So this shows you a little bit about our geographic spread and also the range of services that we have. And you'll see by those stats on the right that we have 50 residential homes, we have 17 schools, that's linked to 9 DFE registered schools. We have multiple satellite schools from those registered sites. We have over 380 transitional services flats, and we support over 900 children and young people. And the geography of that, you'll see there's a real concentration in the West, Central and East Midlands, and obviously now moving up into the North Yorkshire area, and we have the purple, or the pink, I suppose it is, that shows the transitional services core areas that we've inherited. And we bought an organisation called Key 2 back in November 17 with the support of our debt provider, Clydesdale Bank, actually, and Jamie, he knows all about this. What we did there, we looked at transitional living care as one of the key outcomes for our children, because at 16 they can sign themselves out of care, and unfortunately they can't claim any benefits. It was housing benefit at the time, but obviously that's now changed, till they're actually 18. So what was happening was that these children were falling through the system and going back to their default, which was in some cases going back into that abuse or being abusers. So we wanted to make sure the pathway could transition these children through. And to all intents and purposes, transitional services is supported living for children. So some of you will have supported living for adults, but the principle here is it's floating support, supporting children to become self-sufficient, young people actually, to become self-sufficient, and to equip them with life skills that at 18 plus, they can take on their tenancy and it's sustainable. And they're either in education, further education, or in employment. So that will then take them through into that particular sphere. So our overview. So what Henry asked me to talk about was basically what is the main overview in terms of all the drivers within this particular part of the sector. And certainly in terms of acuity, that is one of the key things we're seeing, and my colleagues will probably confirm that. We're seeing a lot more children and young people coming through into LAC that have higher needs. And that's across all of our 3 operating divisions. And that is really, really starting to make sure, starting to underpin that volume of children we're seeing. What I think is important to say is that there's not so much more abuse going on, there's more recognition of abuse. And I think U-Tree, obviously with Saville and all the rest of that over the past 4 or 5 years, has really kind of underpinned that, and local authorities and wider sector, actually wider community, are far more aware of children exempling inappropriate behaviours that could be underpinned by some form of abuse. So there's a lot more awareness now. What we also experienced, and certainly over the COVID period of time, and one of your questions that Henry posed, was in terms of funding. Well, when a child is taken into care, the local authority becomes the corporate parent, and therefore has a legal responsibility to provide care for that child and educate that child. That means that is protected funding, and certainly as far as we're concerned, our clients are our commissioners. We don't do privates at all. It's purely from a local authority perspective. So their priorities, and they do take their responsibilities extremely seriously. We have not had a problem at all through this period of time or in the past, actually, and we're not anticipating any going forward as well, is that if that child is taken to care, they will pay for that care, provision, education and support. So what is also interesting is on point 3 there is that addressable market. And we sold to Graphite last August. And prior to that, we had run a pre-process of EDD and would use particular experts and advisors, one of which is Ellie Kay, and I think there's Ellie Kay actually on the webinar, to look at the market and to look at that kind of shift through, which underlines what Henry was saying. But certainly over the previous 4 to 5 years, there's been a consistent move and transition over from in-house provision of local authorities through to the independent sector. And if you look at those market positionings across those 3 operating divisions, as Henry has pointed out, there is significant scope, especially in special educational needs. And if you look at transitional services, which wasn't really picked up in Henry's note there, there is a real dearth of provision. And if you think that 360 flats, if you look at that from just ourselves as not a particularly big provider, we are the largest provider of independent support for transitional services in the UK with only 360 flats. So you can see that there's a huge need, potential need there. And that's something that obviously Horizon, and I'm sure that people are going to be looking to move towards. Very fragmented, and certainly, as you can tell, I've been around a while, back in the late 80s and 90s, it's very fragmented in elderly care, for instance, before the big players came through, Barchesters of this world and so on, and started consolidating that market. What you're seeing in children's services is what it was like in adult services back then. Very, very fragmented, very few large providers that take any of the real kind of amounts. So I think the top 10 is less than 20% of the market. So there's a huge amount of what I used to call Mars and Pars that are running very small organizations, maybe a couple of houses, maybe a small school. And that is something that's really, really quite interesting. But what the other side of it is, in terms of the barriers to entry, is that you can't just set yourself up as a children provider and just do that. You have got to go through multiple levels and layers through, and Ofsted obviously is the overseeing regulator, to become a children's provider. So there is genuinely high barriers to entry. There's absolutely no question about that. That protects that grouping and that particular market, and it's incredibly appropriate. What you do not want are cowboys operating in our space with very vulnerable children. So I completely concur from a business perspective, but also from an ethical perspective, that it does need to be those high barriers to entry. And the transitional services piece, I think that is something that we've really seen taking place. And we bought, say, Key 2 back in November 17. We bought about 180 transitional flats, and we're now at 380. That just goes to show the potential for growth and the acceleration in that particular part of that supported living model through. Percentage-wise, we have about 20% of our children of the complete 380 are sub 18, from 16 to 18. 80% are above 18. And that's interesting because you're moving away from children funding, but there's a lot of local authorities recognise that that supported living model works really, really well. And they are supporting those children to become young adults. And some of our people that we look after are actually in the early 20s. So there is a huge potential within transitional services. So massive amounts of opportunity in this space, protected funding, high barriers to entry. I think there's a huge amount of potential. And certainly in my amount of experience over 40 years, I've never known a market quite like it. So,
Paul, thank you very much indeed for that. I'm going to move on to Sandy to give us a perspective from a fostering side of the market. What I would say though is just very quickly, I absolutely hear what you say about the acuity. I think around the funding though, I think let's explore that later, because I think there's a lot more demand for funding in other parts of the social care and healthcare at the moment. So there's a lot more competition for this funding now. And then finally on transitional services, one of the questions that's come through, and we can address it at the end, is just around children commissioners being very critical of unregulated supported living and how we make sure that's properly regulated to make sure we don't have a reputational issue, which I think is in the interest of all providers. So on that, I'm going to turn to Sandy, who clearly has a track record with regard in adult social care and is now the chair of Compass Community. And Sandy, very interested to hear what you have to say from the perspective of a more fostering focused provider.
Well, good morning, everybody. I think I'd like to start by sort of explaining that Compass over the last sort of 18 months has diversified considerably, actually. So we're not just fostering, we do residential and education. And I think what's a slight differentiator with us is the fact that we have a very holistic approach to our children. So our children may come into fostering to start with. A lot of them by then have been excluded from schools as well. So it was part of our remit to sort of say, how do we put the child at the centre of the care that we deliver? So what we wanted to do was look at the holistic and the therapeutic angle of the business. Next slide, please, Henry. So Bernie is a social worker by background and is a stalwart of the business. Bernie's experience is huge. She started predominantly in the foster side of things, but has grown and developed over the last sort of 5 or 7 years to grow the business to what it is today, with Jamie's support as CFO. My experience, as you know, has been 20 odd years in healthcare, predominantly in the private sector, some in the third sector, but predominantly in the private sector. But I think what's interesting with Compass is that it has a bit like Horizon, a depth of people with real knowledge. And that's what's important to financiers, because what they want to do is they want to buy good management teams. They need a management team that really understands the sector that they're in. And there's no doubt that the children's sector is complex and sometimes can be very scary, because, you know, these are young lives that we are responsible for moving forward. So I do think that's important to remember that. Next slide, Henry. So Compass, we obviously have a mission, and that's obviously to provide the very best care, like everybody does. But I think what's interesting is we all want to provide the very best care, but it's how do you do it? And some people provide service, but don't actually provide that therapeutic and holistic approach to their children. So we very much wanted a child-centered service. So when 3 years ago, when we were bought by Graphite, we were predominantly fostering, which is what they knew about. And since then, we've diversified so that we have fostering, education, and residential. And what that means is that the children that have been excluded from some schools have an opportunity to go to some of our very small schools, which is slightly different than Paul's, often only 8 desks or 10 desks in a very small specific school. And we tailor the education to the individual child. So we're very fortunate that we have those facilities, and we're very fortunate that we can adapt our schools in that way. So every child gets an opportunity to have some schooling. And the aim there, of course, is to try and get them back into mainstream schooling, because these children often are very bright. They just have had a very unfortunate beginning. So our vision really is to make sure we look after that vulnerable child for as long as possible. And even then, if the foster care doesn't quite work, then obviously we have residential as well, so they can move in and out of their, you know, we all hear care pathway all the time, but we genuinely do deliver a care pathway. So it could be fostering, it could be education, and then it might be into residential if the child becomes very unsettled or difficult to manage, and then hopefully back again to fostering and then adoption. So we are trying to create that general service and to meet customer demand. And I think Paul indicated demand is huge. It far outstrips what we have. The local authorities, I think, are swamped and certainly can't afford to certainly do residential care, because they can't afford the properties and often they can't afford the schools. So I do think this is an area where local authorities are very dependent on us to partner with us to make sure that those children get a good service. But what is important around all of that is quality, and making sure we deliver that in a quality environment, because that then becomes the driver to improve that child's life whilst they are with you. Next slide, please, Henry. So our approach always was the quality side. We differentiate therapeutic approach. So this could be anything from speech therapy, because some children come to us and can't speak. It could be any of the sort of therapies that you know about. It could be just education. It could be emotional. It could be sexual awareness. Some of these children, you know, have had a very tough beginning in life. So we put a whole package of care around the individual child, and then our own therapists deliver that care. And the nice thing about that is we do capture then outcomes, which so many people don't capture the outcomes. And I think what we're trying to do is say, whilst that child is being looked after by us, we are trying to capture those outcomes. And the strength of that is we recruit well. You know, we are very careful over recruitment, the same as Paul is. We have our integration of our platform. So again, we have this national brand. We're all over the country. And if a child can't stay locally because of family reasons, then we can move them to another area, which again is hugely beneficial to the local authorities, because they have a brand that they know and trust, and they can move the child into a different environment. But I think, you know, there's a couple of facts that came out from the NERI report, and that must be 3 years ago now. Only 11% of any child that's gone through the care system goes to university. And I think that's really quite shocking. You know, when you think nowadays 50–60% of all children go on to further education of some description and or university, only 11% in care. So I think it is incredibly important that these early years we wrap ourselves around the children, and we deliver not just care, but we give them tools in education, we give them tools in lifestyle to make sure that they absolutely get the very best moving forward. And I think that will explain itself in our next slide. So we're in an excellent position. We've doubled the size of our business in the last 2 and a bit years. Bernie and her team have done an amazing job. We have very few vacancies. We have more capacity coming on all the time. We will be nearly double our school desks by April of next year. We've doubled our EBITDA. So again, we're a very attractive proposition, you know, and as Paul says, this is cash that the local authorities, by law, by the way, have to pay to keep a child safe, well, fit and educated. So this is set in the law of this country that all our children have that right. So yes, the entry to the services can be quite high, but once you're in there, then the local authorities pay, and there's almost no debt in our books at all. So it is about making sure that during the investment period, you carry on growing and you grow through holistic care, therapy, and also that quality. But that comes down to your senior management team. We all know if you've got a good senior management team, you've got a good business. And that's what bankers look for. That's what, you know, equity houses look for. They look for strength there. That senior management team can't be everything. And they may depend on the bank a bit more for the finance side of things. But what you need in care is you need people who actually care and really do that as the byword. So in our team at Compass, we have a fantastic team all the way through that care. Our turnover is relatively low in comparison to many businesses. So we keep our staff for a long period of time. And all the time, we are trying to make sure that whatever that child's need is, we can facilitate it. And I think that is vitally important to that child's outcome. Thank you.
Thank you very much indeed for that, Sandy. And I think just to sort of pick up on a few themes there, clearly one of diversification. So whilst the business may have been more fostering focused under August Equities ownership, under Graphite, it's clearly diversified into schools and residential as well. And I hadn't appreciated actually how far you'd already taken that. I think that obviously dovetails with this whole concept of care pathways and moving people into the appropriate setting at the right time. And maybe we can explore that in the Q&A. So I know talking to Paul, whilst there is some overlap in terms of, for example, children who might be in a residential service and attending one of your schools, actually the overlap isn't necessarily as much as you might think. The second is quality, and that's all around culture, but also is measurable in terms of the quality of the care and the level of staff turnover, and really comes down to the team. And I think that's a theme that we see come up again and again. And then the final thing is just growth and demand. We've got nearly 100,000 looked after children in the country at the moment. The reality is there probably ought to be a lot more of them, but they haven't made it into the system. It's effectively being rationed, but that demand is clearly there. So I think on that, I'm delighted to ask Ian Marlowe from Ardenton Capital to talk about why Ardenton invested in the sector. And again, what I hadn't appreciated in talking to Ian yesterday is that Ardenton is not another private equity firm, in as much as they're very much long-term capital. They buy assets and hold them for 25 years. And I think that's a very interesting perspective when we look at a sector like children's services, where a long-term hold, just as with the infrastructure players like On Time with Kisimul, for example, is an alternative way to investing in this sector. So Ian, over to you.
Thanks, Henry. Good morning, everyone, and thanks for letting me speak this morning. It's worth me saying at the outset that just as Paul says, it's a sort of privilege to work in and speak about the care sector. It's for the likes of Ardenton to get to invest in it as well, and it's probably worth emphasising that more than any other business. And I note some of the questions that have come across on Slido asking about reputational risk, is that it's not an investment that you take lightly. This is a business like no other, and we're very acutely conscious of the responsibilities that come with investing in a business and a sector like this. I've been asked to talk about the sector from the perspective of an investor, so please indulge me whilst I explain that Ardenton are not here purely as a healthcare or as a care specialist. We are fairly generalist in what we invest in. As Henry said, I should stress we're not a private equity fund, so that does lead to some differentiation. Many people think of us as a private equity fund because we invest in a similar way, but with a very crucial difference, and that being we invest with no intention to divest, which from our perspective makes the care sector and certain attributes of it very appealing as a sector in which to invest. Worth noting, so we are North American based, so we're founded and owned and indeed funded equity wise from North America, home office being in Vancouver. We as well as sort of in terms of working and investing in businesses into perpetuity, we have a very big focus on our sort of a partnership model with management teams. So as much as I'm here to talk about the care sector today, we don't come into any investment claiming to be the experts. We're not. We want our management teams to be our experts. We want to be there to help those businesses in any sector which we invest identify, refine, and ultimately deliver their strategy in their business in their market. So we come there as hopefully as not as sector experts, but I suppose as growth experts. It says there on the slide, Ardenton has been operating in the UK since 2016. So we've invested in a range of different end sectors, which range from our very first investment into hot dip zinc galvanizing in Corbett's the galvanizers, so it couldn't be any further from the care sector. But our most recent investment back in November, as Henry mentioned, was into Pebbles Care. The other, just worth mentioning briefly, the other sectors in which we have an interest, both in the UK and internationally, being in, of course, health and social care, food, tech and communications, consumer products, and a bit of a catch-all into business solutions. So if I can just go on to the next slide, I'll explain a bit about exactly what, as an investor, did attract us to this sector and specifically to Pebbles. So first and foremost, I think this sector very much lends itself to a long-term investment model. And particularly given our differentiation in trying to buy businesses that aren't the fully formed perfect article, and that's in all the sectors in which we invest. Is taking those business with an opportunity, with a market opportunity, but for some reason have a constraint within that particular business to growth. Quite often that constraint can be simply ownership. It can be the original founder who takes a business to a certain size and perhaps no longer has the risk appetite to invest to grow further, or perhaps just doesn't have the skill set and the knowledge to build that business out and grow further. That probably accounts for most of our transactions is buying from those owner managers who simply reach their particular limit with that business. But in terms of turning businesses round like that and putting the investment into it, that takes time. It takes time to invest. Sometimes it can mean taking a step back before you take a step forward. What do I especially like about the care services market is that Henry has demonstrated the amount of private provision there is, particularly in children's care services now. And so quite clearly, the investment market is sold on the fact that care services is a good market for returns to invest in. I especially like it from my own personal perspective, because you cannot drive growth, you cannot drive success, profitability without an uncompromising approach to care. Certainly for the long term. There are short-term wins to be made, efficiencies to be made short-term, but unless you invest wholeheartedly into the quality of your care provision, then your business will not succeed. And that is very much our uncompromising approach to Pebbles. So I talk about the responsibility that we have, the responsibility to ensure that we provide best-in-class services to our children. So Pebbles is a business that we invested in last year. It was a business founded originally by a property investor, and probably it's fair to say for the up until the point we've invested had very much a property strategy led approach. But the best thing that the previous owner ever did was appoint a very strong team, a team that had that uncompromising approach to the quality of care to the children. So what we at Ardenton saw was an opportunity to take that embedded quality of service and help the business ultimately deliver better care and care to more children, because we all know there is over demand and under supply. Hence, you can look in the news to see the number of from time to time the number of people referencing the amount of unregulated homes there are out there. So Pebbles was a as you can see from the map there, has a scattering of homes amongst the north of England and into Scotland. Indeed, 30% of our 105 looked after children are based up in Scotland. It's probably worth noting actually that only 1/3 of those placements in Scotland are actually Scottish children. So Pebbles very much specialises in those high acuity needs children who come from previous placement breakdowns, children, certainly particularly vulnerable children in the 10 to 18 bracket, who are often moved well away from their homes, and with good reason, because there's a good reason why they need to be taken out of their environment, and we hope ultimately possibly not found by the people in which they're being removed from. Hence our presence in what are fairly rural areas. We should say that in November, so we acquired a majority stake. That is our model. We strengthened that exec team with the appointment of Mike Walsh as CEO and Liam Bain as the finance director. Sandy referenced something actually, and it points to another opportunity, and another constraint within businesses like Pebbles that has grown to a significant size, and why such a key appointment for us was Mike and was Liam. Sandy referenced the lack of tracking of outcomes. That's so important. If you're going to go to local authorities and ask them to pay the weekly fees that we do, then you need to be able to justify that. You need to be these organisations cannot operate on big hearts alone. Perhaps once they could, and many organisations are founded on big hearts, and we need them. But today, to succeed in this market, you need more than that. You need the care models. You need the psychologist team. But crucially, you need to be able to track the outcomes. There's no point working with these children to help improve their lives and ultimately help them to succeed in life as individuals. If we cannot say to the local authorities, this is what we've done, this is how we've done it, and look at the outcomes. And so infrastructure within an organisation is such a key piece to make it ultimately attractive to investors as well as being able to demonstrate we're doing the right thing by the children. What are we overall aiming to do? I think you might have got the picture by now. We are hoping to improve the service offering. Already very strong service offering, but to improve it further, to expand the offering, both in terms of numbers, but also in terms of the actual service. And one of the things that we've been focused on very recently is launching our first mother and baby unit up in Cumbria. Many of you on the call may well be aware of the lack of service provision that there is for mother and baby units, and all too often young mothers are separated from babies when they need to go into care, and we very much see an opportunity there to where appropriate, provide placements where mothers can be kept together with babies, and those mothers helped to become parents and hopefully improving their outcomes for both the mother and the baby later in life. Henry, that's it for me for the introduction for now. Otherwise, I'm in danger of going on for too long, I suspect.
Thank you very much, Ian. I think the tagline up there, Ardenton, partnering for growth, sharing success, actually probably sums it up quite nicely, which is you are very much supporting these businesses. Focus on quality, focus on the long term, investing in the infrastructure and the people, looking for best in class outcomes, and being able to demonstrate that, being able to track those outcomes. So I think that from an investor perspective sets the scene very nicely for Jamie to talk about the perspective of a lender into this sector. And Jamie, before you start your piece, there are a couple of questions that have come up in terms of leverage, specifically around some local authorities being concerned about debt levels. And I think it'd be interesting to know as a lender whether you see that as a concern as opposed to as a commissioner of these services. I think Sandy mentioned there's not much leverage in Compass Community, which I was very interested to hear. That either means that it's over-equitized or there's plenty of firepower for acquisitions. But I think, Jamie, from your perspective, also it'd be good to hear where you see leverage in the sector, because I think traditionally people have been more comfortable with asset-backed businesses like schools and to a certain extent residential, and have been more cautious around asset-light businesses like fostering. So whereas they might be comfortable with, I don't know, 3 or 4 times leverage with a fostering business, they might push that to 5 or 6 with an asset-backed business. So it'd be very nice to get your perspective on that. So on that, I will hand over to you.
Yeah, thanks, Henry, and morning, everybody. Just start with a wee bit of background on who we are. Clydesdale and Yorkshire Bank is part of Virgin Money UK PLC. We've had a long-established specialist health and social care team, and we now manage well over £1 billion worth of assets in the sector, and we continue to have a strong mandate for growth. There are 21 of us across the country, good mix of bankers, accountants, and corporate financiers. And as I say, we provide national coverage of the sector. Increasingly over the last few years, we've had a stronger focus on specialist care, and children's care services are a particular area of focus for us and in our growth. And I think it's worth saying that we think we have a useful advantage in that in the same team we've got the skills and experience and expertise to transact new private equity deals as well as doing refinancings and development finance and growth facilities, which certainly helps in terms of the way we go to market. Second slide, thanks, Henry. So the children's services sector itself, I mean, our view is that the sector is a dynamic, attractive sector for investment. As has been mentioned already, we've seen the sector largely financially unscathed by COVID. I'm clearly not downplaying the significant operational challenges that COVID continues to bring. And again, there's an attraction in a highly fragmented sector with a trend towards consolidation. As Paul says, it's sort of following in the tracks of adult care a number of years before. And we see a need for innovation and system change alongside capital investment in new services. Again, I mean, certainly Paul and Sandy have both touched on the fact that demand continues to be very high and growing, and supply of places, particularly at the high acuity case end, is in short supply. So, I mean, we see that private equity, as well as knowledgeable sector-focused banks, have played a significant role in provision of capital, and we think that role will continue. Certainly, as a specialist team, we understand the central importance of quality of care, and also I think the nuances of regulation, which can be quite difficult for generalists to get their head around. And then, you know, we've been involved in a number of significant transactions, a couple of which have already been spoken about today, but there's a few more on that slide. there. So next slide, Henry, thank you. So in terms of where we see the sector heading, we've already seen some stats from Henry at the top of the webinar, and certainly the number of looked after children is growing, up over 12% over 4 years, up over 4% in the last year. And I think as Henry's mentioned before, there are many more on the edge of care, and I think sadly the increasing demand has been exacerbated by the COVID pandemic. So we're in no doubt that the demand will continue to accelerate. Why are these children in care? 63% as a result of abuse or neglect, 22% as a result of family dysfunction and acute stress, and 75% come into care following a court order. So, I mean, and as Paul alluded to earlier on, that this sort of poor start in life can have significant effect on a children's life, exhibiting complex emotional, mental health needs, difficulties in forming stable relationships, and many are exhibiting challenging behaviours which have been exacerbated during the pandemic. So significant spend by local authorities in this area. Interesting to put it into context, the sort of near £10 billion that's budgeted to be spent by local authorities on children's social care is about 10% of the total local authority spend across all areas. 35% is education, 18% adult social care, and 13% police. So significant funding requirement here. But as I said, and certainly in line with some of the attractions that Ian's laid out, we see the outlook for M&A in the sector being very, very strong. And the key areas that we're looking for have already been mentioned on the call. True of all sectors, but particularly in this sector. To us, the value of a strong, well-balanced management team is absolutely paramount. And quality of care is central and fundamental to any investment we make. So if we don't see quality and we don't see strong management team, we tend to pass. And I think, going forward, as we've said, over 80% of children's homes are privately owned, and we think that the private sector and private equity investors have a key role in growing provision of high quality care and education for these vulnerable children. And as a bank, as a lender, as a bunch of sector experts, we want to continue to support that as much as we can. Just to finish, Henry, on the point you raised on leverage, our view on lending into this sector is always based on debt serviceability. We're not coming at it from a perspective of LTV. We'll look at the cash flows in the business, we'll look at the sustainability of the cash flows in the business, and make sure there's significant headroom in there. We don't want to be over leveraging these businesses at all. So clearly asset-backed businesses can support a higher level of debt, because the amortization of the debt can be put over a longer period of time if you've got the asset backing. But certainly the fundamentals of asset-light businesses are very attractive to us, but again comes down to strength of management team and the quality of the care provision.
Thank you very much indeed, Jamie. I'm just going to go back to the poll that we had earlier. What's the greatest challenge for children's services? I was quite interested actually how funding competition is the #1 challenge. And I think that's a good sort of lead into our questions. And the second one is staff fatigue. And there's no doubt that that's actually linked to the third, to COVID, some of the challenges that people have had throughout lockdown. But on funding competition in particular, if we look at the adult social care sector, what we've seen is that there has been a shift in that funding towards higher acuity services. And I think, you know, it would be very interesting to hear from the panelists whether they are also seeing that shift to higher acuity. In adult social care, essentially, if you've got fees of, I don't know, £1,000 to £1,500 a year, you're in danger of being commoditized. And you're looking ideally at fees at sort of 1,800, 2,000 and up, where your funding is more protected. So I'm just going to put the Q&A up on the screen as well. But why don't I start with that funding question, given that's coming out of the polling? And Sandy, maybe if I start with you, since you've diversified out of that fostering business into the two other major segments of the market, and you indicated that high acuity was absolutely a core part of your strategy.
Well, I think it's threefold, really. I think, first of all, high acuity is, but it's how you can present a bundle of care services to local authorities, because to them, if you become not quite a one-stop shop, but if you can do that for them and they're happy with what you're doing, then it's a much easier prospect than finding residential, then trying to find a school, and then trying to find some aftercare. And so I think if you can try as a business and look at the pathway of whatever, whether it's a child or an adult, and say, right, you know, they wake up at 7, what am I going to do with them till 10 at night? And then work out how you do all those things, then I think these businesses can diversify very easily, and therefore they kind of start to attract extra packages of money from different areas rather than just the residential or just the educational. And certainly in Compass, that's what we've done. We've done it almost by default, by putting the child first and saying, well, what does this child need? And for us, it's paid dividends, because now we have income streams coming across lots of different things. So a residential placement might be £3,000, but then if we add education onto that, that's another £1,000 or £1,200. So, and then therapies on top of that could be another £700 or £800, depending on where we are. So that certainly helped. I do think that the lower end is getting squeezed. So the supported living and residential at the sort of 600-800 to 1,000 is getting squeezed, because often they are adults in their later part of adult life, and consequently they're reasonably settled, so that it's hard to get the fee uplifts. Whereas if you're churning your staff, your beds or your spaces, then the next person in might be more complex, and therefore you can up your AWF. So it's a balance of getting that right. The other thing that is actually quite tricky is compatibility as well, because when you've got small children's homes, if they're homes of 5 or 6, getting that 5th bed filled can be quite complicated because of the compatibility with other children. So you've got to have some really good therapists around you to make sure that they can put in a package of care around perhaps the latest child coming in on that last bed, to make sure that that's good. And of course, then you have to also pay the staff more, because it's more complex. And certainly in London, we've got quite a good niche going on. We've retrained quite a lot of our foster carers in London to take more complex children. And that commands a better fee for them and a better fee for us. So again, it's going down the acuity route.
Thank you very much for that, Sandy. And I might actually just ask Paul to maybe talk to that acuity point, but also to the next 2 questions on here, which is around the supported living offering and the lack of regulation there. And maybe how you, from a quality perspective, are managing that, and how you present that to commissioners as something that they need not be worried about. So that acuity question, but also that regulation piece.
Okay, well, yeah, the acuity side of things is without a doubt is what we're seeing in terms of the intensity of need that's coming through, and organisations need to respond accordingly. And we have a large therapeutic team led by a director of clinical services. Internally, in terms of how we monitor the effectiveness of that, we have a clinical governance type aspect to our organisation as well. So there's an accountability of that kind of clinical outcome aspect, which is really important. But what we do is make sure that we equip the frontline services with that therapeutic approach. So it's therapeutically led services is what we do. And the local authorities and commissioners recognise that as being a core aspect of the type of quality delivery that needs to happen for these children. So Ian talked about outcomes, so making sure there are potential, proper outcomes through. So, it is that therapeutic aspect that can help monitor that and actually prove that there is being progress and stability of behaviours, attendance of school in a better way. I mean, some of the children we have, it's been alluded, they're highly intelligent. A lot of these children, that's absolutely right. But school can represent that kind of abuse or issue, and a number of our children have been to school for 3 or 4 years. So immediately they're starting from a back foot. So, making sure that child feels confident and safe, supported, therapeutically led, that then obviously then manifests itself in children's going to school, starting to achieve and be more confident in society as well. So that's the acuity side. In terms of regulatory, yes, we are regulated obviously by Ofsted in residential services and in education. It is unregulated in transitional services leaving care. But the commissioners who commission onto us, and we're part of all main frameworks, and of course you can't provide leaving care unless you are in a framework, the contract monitoring is intense. And the reason for that is twofold. One, it's not regulated, and the commissioners have a duty of care to make sure that services are provided in an appropriate way. And two, they are regulated by Ofsted. So Ofsted are coming through the back door in many ways. And so there is a kind of reverse backdoor aspect from Ofsted into the transitional services leaving care. It is floating support. Outcomes, again, super important. And the IT that support that, the MI that we have in the transitional services on real-time outputs in terms of what are we doing with each of these young people and how are they achieving on a daily basis is super important. And, that is one of the critical factors in here. It won't be long before there is regulation in transitional services, and we would absolutely welcome that. There's no question about that. And we operate at a regulated perspective in terms of our record keeping and in terms of our self-awareness as well. So the quality director that we have in the organisation has complete authority and autonomy and responsibility for transitional services as equally as she has with education and residential services. So it's treated just the same as all the other regulated services.
So I think, Paul, to sort of paraphrase that, you internally run the services all in the same way and approach it in terms of maintaining quality in the same way. But the regulator at the moment does not, but you think that will change?
Yes, it will change that, yeah.
I think there's a question that's come up on valuations, and I think one of the differences with our webinars is we are focused on this as investors. And I guess, Ian, in particular, if you've recently acquired a business, and I'm sure you paid a platform multiple for that significantly higher than the 5 times suggested here, but where are you seeing valuations go for individual smaller assets? Because there's no doubt that buy and build strategies are absolutely a critical part, particularly in this fragmented market. And I wonder whether you could comment on how you see the broader market.
Yeah, sure. So look, the buy and build strategy is clearly very, very common. It is a very fragmented market and therefore ripe for consolidation. Of course, the platform multiples are significantly higher than 5 times, but you won't need me to explain the pitfalls of a buy and build strategy at times with any business, but again, particularly with this, is as an acquirer, you have to be very careful in the type of organisation you buy, its people and its practices. And there is a number of people who would say that buying another business, particularly in this sector, is also buying in problems. And you talk about valuations for single homes or just a handful of homes, is that as an investor you have to weigh that up against the cost of simply buying greenfield. So would we, for example, buy single homes perhaps if they offered a strategic benefit? But one thing that we as an investor won't do is probably buy single homes in order to build scale. We see a much better fit with finding our own site, making sure that it aligns to our wider strategy and our offering in that particular area. and effectively establishing it greenfield, finding the right property, converting that property, registering that property, and finding the right people, and people who from the very outset will work and conduct themselves in a way that aligns to our practices. So would we pay 5 times for a single property? Probably not. The cost to set up a home from greenfield is significantly lower than that.
Thank you very much for that, Ian. It's always a difficult question to answer because, of course, everybody wants a number and there isn't a single number to give. But I wondered, Jamie, if I could just ask you as a lender, where you're seeing valuations as well, because clearly the quantum of debt is partly driven by the cash flows, but it's also driven by the amount of equity that investors are putting in, which obviously also solves to the multiple. Have you seen multiples expand? And you know, what is your view in terms of where they're heading for the sector?
Yeah, I think as you say, it's very difficult to put an absolute number on this. There's a whole host of factors come into it. I would certainly say that valuations for attractive, high quality platform assets are continuing to go up for many reasons, but you know, clearly my cautious side is in line with Ian. You do need to make sure that platform is absolutely what you want, and it fits an ability to grow from it. I mean, certainly in children's services, my experience is the same as Ian's just laid out, that actually there's generally a lot more value to create in terms of buying an empty property and kitting it out and making sure it's right for your service users, and then actually you've got the right culture ready made to go into that home rather than necessarily acquiring another home. So I don't see valuations for single assets or small groups of assets being hugely inflated for those reasons. I don't think there's any real reason as to why they should be inflated. We're seeing certainly a trend towards higher levels of equity investment rather than debt investment, which is a very different position here than, you know, pre the 2008 crash, where you know, debt levels just seemed to go up and up and up, and everybody thought that asset values would just continue to go up and up and up and everything would be okay. It certainly seems that the market to a certain extent has learnt its lesson from that, to the extent where higher platform multiples need to be paid, that additional multiple is being funded by equity rather than debt.
I think we've got a lot of votes for the top question here, so I can't continue to ignore it. So John Lucas has asked, children's services are increasingly transferring to employee ownership trusts rather than to private equity and trade. And what are the views of the panelists on this? And I think it is an interesting question, because I can see why an EOT might be a more acceptable owner of some of these businesses, but I also wonder whether they are competitive in terms of, you know, being able to pay up for these businesses, and how often actually the panelists see assets that they're pursuing trade to employee ownership trusts. So maybe I'll start with Sandy. Is this something that you've noticed at all in the market?
No, not significantly, and I do think it can be a high risk. You know, we've moved away from mom and pop type organisations, even quite big mom and pop type organisations, into something that's slightly more structured around regulation, etc. And I think it can be a worry, because I think employee ownership trusts are fine at the moment, but if the regulation gets stricter and the regs get more complicated, the money that you need to ensure you're keeping up with all of those standards, whether it's building standards, whether it's Ofsted or CQC, is quite onerous. And so I would be more concerned about them moving that way more than keeping, it sounds quite sexy, it sounds like being a charity to a local authority, but then, you know, we all know how charities have had really struggled recently. You know, Leonard Cheshire sold off their homes because, again, they couldn't afford to keep them. Real estate is complicated as it is. So I'm not an advocate of it, and I haven't seen a great deal of it.
Paul, are you seeing any of this in your businesses?
No, very little. One of my previous lives was for not-for-profit. I worked in not-for-profit world, and Sandy's spot on actually. The ability of to be able to invest and invest quickly as well. I think that's one of the key things that private equity can provide. You know, our decision-making ability to be very, very fleet of foot is something that you'll find an EOT will not really have the ability to do. I think initially there may be, you know, there's lots of, you know, impetus, momentum there and desire. But as regulation does start to tighten up even more, we've seen Ofsted certainly doing a lot of that in the rise of acuity, the heavy investment needed in support services like, for instance, therapeutic. My view, my experience, my personal view is that I think the EOTs are going to really struggle in this space. So the fluidity of the PE world, I think, and the ability that, you know, you're basically generating, you know, your profit and that then goes straight back into frontline services immediately is really, really important. So I've not been aware of hardly anything at all. I don't know if Jamie has.
Jamie, you said you've seen some of this and some experience of EOTs.
Yeah, I mean, as a bank across wider sectors, we've funded a number of these transactions. We've not seen it of any particular note in health and social care. We have seen a few more recently, and I think I agree with what Paul's just said. Actually, I think as a mechanism for owners to release equity or transfer ownership will grate, maybe for owners who are nervous of transferring to private equity and nervous about the cultural change that they sort of perceive that might bring. It might have positives, but I would worry about the ongoing level of capital investment, the ongoing level of investment generally. Where do those funds come from? And I think private equity is significantly better placed for that, and you know, notwithstanding the comments that both Paul and Sandy have just made about the regulator, so I would probably be quite wary about those transactions in social care.
Very good. We've got 2 minutes left, and I'm going to roll up a couple of the other questions and just ask the providers in particular. So this is really, you know, all three of the providers are multi-geography, at least regional, if not national. So are you seeing local authorities retrenching into their local area and abandoning some of that regional and national cooperation? Are you seeing the lack of Ofsted inspections impact your business as well? And has there been any change in behaviour from commissioners? So I guess it's really around commissioner behaviour and regulator behaviour during COVID. Are you seeing any of those changes? And maybe I'll start with you, Paul. I'm afraid it literally is 30 seconds, and I'll come to you, Ian, and then Sandy.
Okay. We have in certain circumstances, yeah, so education, what happens with placement education is they meet as panels, local authority meet as panels. We've seen a lot of deferring of those panels through the back end of last academic year. Those now have actually changed, and a lot more panels are sitting right now, and we're seeing a lot more children coming through into our schools and our desks. But it was quite frustrating the last term in particular, panels just weren't sitting. Yes, in terms of residential, again, with the COVID situation, they were basically trying to keep children in their own houses, and they were reticent about moving children around houses, and obviously those home clusters. And that a lot was linked to the government guidance on COVID, and obviously making sure that homes were kept or families were kept in pretty preserved units. But again, we're seeing that relax quite well. And yeah, again, we're not seeing that to be a major problem. But in terms of regionally, that's across all the regions. So yeah, that's mine.
Ian, just a few thoughts from you on this.
As time is short, I'll make it brief. Two key observations. One is that yes, lack of inspections have delayed openings of new homes. So we have, as it stands today, 5 homes all waiting to open, and it's taken many more months to get those inspections to take place in order to be able to open and fully commission those homes. So that has had an impact because of COVID. The other point about cooperation nationally is I suppose the introduction of court orders that make it more difficult for us to take children from England and Wales and to put them into Scotland. Key part of our business being in Scotland, and the differentiation seen by the regulators there between Scotland and England and Wales has created barriers to us to placing English children in Scottish homes.
Thank you very much. And Ian, Sandy, just to wrap up, anything to add to what Paul and Ian have said? I think you're on mute.
Just a couple of things, really. It's been very varied. We've had some virtual Ofsted approvals, which has been fantastic. So we've sent all the documentation, photographs, etc., of new homes, and we've had them done virtually. So we've been quite successful at doing that. The area that we've been less successful is we've had monitoring visits, but those monitoring visits don't count towards your quality, and that's now got to change. That's ridiculous. They do a full 2-day quality monitoring visit, and then they won't change. If you've got a required improvement, for example, they won't change it. They're saying that you have to wait for the full inspection, which covers exactly the same thing. So it's very variable, I think, is what I'd say, which is a great shame, because some of the authorities are fantastic and some are not.
Fantastic. Well, look, thank you all very, very much indeed for joining. Thank you to Clydesdale for partnering with us on this. Care Markets is our journal that covers the sector, and Turn to Us is the charity that we've supported throughout COVID, which helps people who really are in need and works closely with the Care Workers charity. So thank you all very much. We have our Social Care and Retirement Living Conference coming up in mid-October, which I hope will be in person, but will probably be virtual. We actually have Jeremy Hunt as the key interviewing partner there. It'd be interesting to see what he has to say about life. But on that note, again, thank you to Clydesdale, thank you to our panelists, and really interesting session on children's services. Bye.